Earnings season is here and we're kicking off with the financials. Here's what you need to know. If you want to be an investor, it is a must you stay up to date with these earnings reports. It gives you a financial foundation for how the company's performing, but it also ensures that the story is staying intact for your investment. Now, financial earnings get a bit complicated and we won't get too much into the weeds, but we're going to really leverage these reports to give us a better understanding of the general macroeconomic picture and the stock market as a whole. It's important to note that when referring to estimates, these are coming from the analysts on Wall Street, the people that are covering these companies. Think of these as important hurdles for these companies to get over to show whether they're outperforming expectations or what's priced into the stock. But misses compared to expectations can cause stock prices to move to the downside. Starting off earnings season is going to be the financial companies, and we're focused on 4 key players today. 1, JP Morgan, the world's largest bank. 2, BlackRock, the world's largest asset manager. 3, Morgan Stanley, a key player in wealth management, investment banking, and trading. And 4, Goldman Sachs, again, another key player in investment banking and trading. Let's start with the largest bank in the world, JP Morgan. JP Morgan reported revenue of $46 billion versus the analyst estimate of $44.1 billion. Of their $46 billion, $23.4 billion came from net interest income and $22.6 billion came from interest income. Net interest income is simply just the difference between their interest income and their interest expense. Non-interest revenue is from services such as fees, trading, and investment banking. But more importantly here, JP Morgan actually raised their net interest income guidance from $94 billion to $94.5 billion. Why this is so significant, especially this quarter, is that we're dealing with so much macroeconomic uncertainty. Most people are assuming that companies are just not going to give guidance whatsoever or come in at the low side to set up expectations to be lower while we're dealing with all this uncertainty. For JP Morgan to bump up their net interest income guidance is a key sign for the full year. Going on to their income, net income for the quarter came in at $14.6 billion with an EPS or earnings per share of $5.07 versus the analyst estimate of $4.64. Return on tangible common equity of 21% well outpaced what analysts expected for the company and beat their own internal targets. Return on tangible common equity came in at 21%. What this number demonstrates is essentially shows you how JP Morgan is using their core equity or their core profits to make more money. This number came in above analyst estimates and their internal targets, which is a great sign and shows execution better than expected. They also gave money back to their shareholders through a $7.1 billion share repurchase in the quarter and $3.9 billion in dividend payments, or $1.40 per share. JP Morgan also continues to strengthen its fortress balance sheet and now sits on CET1 capital of $280 billion with a CET1 capital ratio of 15.4%. Think of CET1 as the bank's core capital or financial cushion for the tough times. There are regulations requiring banks to have at least 4.5% in a CET1 capital ratio, which is calculated by dividing the CET1 capital by the risk-weighted assets, thinking of risk-weighted assets as things like loans weighted on their average level of risk. At these levels, JP Morgan sits extremely strong and truly demonstrates their fortress balance sheet, showing that they can really weather any storm. This is especially important today while we deal with all the uncertainty in global trade policy and tariffs and the macroeconomic picture in the short term. But past this report itself, JP Morgan gives us great insights into the economy at whole, and the credit and debit card sales volume was up 7% year over year. But they also see a front loading of consumer spending right now due to the short-term fear of tariffs raising prices in the near term. They are seeing some signs of weakness in the lower consumer segment, but no distress. In fact, the most recent uptick of consumer spending came from this lower income segment. But in terms of macroeconomic outlook, JP Morgan's actually lowered their recession outlook from 60% down to 50%. Jamie Dimon noted that not all issues or uncertainty will be cleared by the next quarter, but we should have a much, much better picture of where we're at with that global trade policy. Finally, Jamie finishes touching on regulation again, noting that JP Morgan shares 1 trillion bits of data daily to regulators. To put this in context, this is about 41,666 photos shared a day to regulators. Deregulation should help to significantly reduce costs for JP Morgan, therefore supporting their bottom line. Now, onto the world's largest asset manager, BlackRock. BlackRock manages $11.6 trillion in assets. Their earnings always give us great insights into the economy and the stock market as a whole. BlackRock reported revenue of $5.28 billion versus analyst estimate of $5.31 billion. But Revenue year over year grew 12%. EPS came in earnings per share at $11.30 per share versus analyst estimates of $10.10 per share. Operating income, just over $2 billion, working with an operating margin of 43.2%. BlackRock also gave back to shareholders, repurchasing $375 million in their stock, and paid out dividends of $5.21 per share, roughly a little over $800 million back to shareholders. They also had net inflows of $140 billion, even amid this tough market backdrop, and organic base fee growth of 6%, beating their internal target of 5%. But BlackRock isn't only a leader in public and private market investing, they're also becoming a leader in financial technology. Touting 14% technology annual contract value growth. Larry Fink on the call also reiterates some key points that he shared in his annual letter. GIP, Preqin, HPS, all coming together to help improve the private investing landscape, with the HPS acquisition expected to close by the middle of this year. BlackRock also expects to announce target date funds at the middle of this year, beginning to give access to the private markets. But the key story with BlackRock, in my opinion, is playing the $68 trillion global infrastructure boom. Last month, BlackRock announced their largest infrastructure investment with an agreement in principle to acquire 43 ports in 20 different countries, therefore giving their investors a portfolio now of over 100 ports around the world. But they also expanded their AI infrastructure partnership, welcoming xAI and NVIDIA, alongside Microsoft and MGM. The partnership will meet their $30 billion AI infrastructure investment goal and believes this could unlock up to $100 billion in investment potential. But in terms of macroeconomic takeaways, Larry does note that this market shock is a little bit different than previous ones in the past, but they do not see systemic risk within the economy. Larry finishes the call noting that we are dealing with some uncertainty, but big macro trends are still alive and well. AI, global infrastructure, debt refinancing, just to name a few. We still need to build out data centers and energy. We still need power for grids and semiconductor plants. And infrastructure will continue to grow dramatically over the coming years. He emphasizes this point when sitting down with David Faber and Jim Cramer on CNBC. Check out this video.
Financing some of that build out, of course, being a key partner, for example, in the build out of the AI infrastructure in terms of data centers and everything else.
And obviously not worried about the peak in data center that Wall Street's so fixated.
There's no peak.
There's no right.
And in fact, the capex that's necessary to do that is only going to grow. As we democratize AI, we need more data centers because the utilization will be greater.
Now let's take a closer look into investment banking and equity trading, moving on to Morgan Stanley. Morgan Stanley is a key player in investment banking. Think of this as mergers and acquisition or IPOs or initial public offerings. They're also a key player in wealth management and equity trading. All of this together gives us great insights on the market. Morgan Stanley reported revenue of $17.7 billion versus the analyst estimate of $16.6 billion. Earnings came in at $4.3 billion or an EPS of $2.60 per share versus the analyst estimate of $2.21. Morgan Stanley had 23% return on tangible common equity, again showing a great sign of overall execution. They added $94 billion in net new assets, bringing their total up to $7.7 trillion. But some of the main takeaways from this report were exceptional trading results. This comes from the volatile environment that we find ourselves in due to all the global trade uncertainty. Another thing to note here is that trading is CEO Ted Pick's background and core competency, showing his strength here and leading Morgan Stanley to be a true powerhouse within the equity trading. Ted also notes that overall they are cautiously optimistic on the market and the economy, noting growth is slowing, but they do not expect a recession as their base case. But in terms of investment banking, this was not as strong as trading. Volatile environments are much better for trading than they are for M&A and IPO. But they do see this as more of a pause and not a complete abandoning of M&A or IPOs. They also note expectations for the tax bill being passed and deregulation, which should be bullish tailwinds for the market. In fact, Treasury Secretary Scott Bessent continues to reiterate this. My take is that tariffs are very bearish to the markets as seen by recent price action. Tax reform, I believe, will be pretty neutral as we're just trying to mostly hold on to the current rates that we have. but deregulation should be bullish. Rounding out our financial earnings is Goldman Sachs. Goldman is the leader in investment banking and a true powerhouse in equity trading. Goldman reported revenue of $15.1 billion versus analyst estimates of $14.7 billion. Earnings came in at $4.74 billion on EPS of $14.10 per share versus estimates of $12.30. Return on equity came in at 16.9%. Goldman also announced a major buyback plan of $40 billion, continuing their approach to reducing the share count. In fact, a staggering stat about Goldman Sachs is since 2010, they've reduced their share count by 45%. This is great for investors because it lowers the share count, therefore reducing dilution of the company, meaning that you as an investor will get more of the earnings per share, more ownership of the company without having to put up more money. CEO David Solomon noted that this quarter was one of rapidly shifting sentiment. The Goldman economists are highly respected on the street, and they lowered their growth forecast for the US economy, going from a 2% growth down to a 0.5% growth now. But the star of the show here was Goldman's equity trading unit, blowing away expectations, again, due to the highly volatile market, leading to great trading conditions. But this environment wasn't great for investment banking. Goldman is the leader in investment banking, with huge deals this past quarter, such as the Google and Wiz $32 billion acquisition. They were also co-lead as a financial advisor to Sycamore Partners for their $10 billion deal to bring Walgreens private. Goldman did miss in the investment banking unit due to the volatility in the market, making M&As and new issuances tougher. Even with this backdrop, David Solomon did note to expect significant amount of M&A activity to pick up in the second half of this year. Overall, M&A activity and IPO activity could be extremely bullish for the market in general, showing positive sign of sentiment and positive business activity. M&A activity and IPO activity in general are extremely bullish for the market, showing improved sentiment and business activity. In closing, we are starting off earnings season strong. Overall, there are three main takeaways. Everyone is noting that we are in an uncertain environment with slowing growth and a need for clarity on tariff policy. This volatile environment has been great for trading with large moves in stocks and securities, but not so great for investment banking, signaling a pause for M&A and IPO. All these institutions are generating large amounts of capital reserves due to the uncertainty. They're focused on returning money to shareholders via buybacks and dividend payments, and deregulation later in this year should help accelerate that. We're just getting started with earnings season, and so far so good, but CEOs do have a cautious tone due to all the uncertainty and slowing growth. Earnings reports are key to staying informed with the fundamentals of companies, industry, and the foundation of these businesses. It's a great way to ensure the financial fundamentals and the story itself are still intact, while you get a chance to hear from the CEO, CFO, and take on questions and answers from analysts themselves. Subscribe to stay informed on these reports, and like this video if you'd like to see more earnings reports going forward. Drop a comment below with any thoughts or questions.